Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics that we've been discussing here at Quilter Cheviot. So as to not miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. My name is James Coker, and I'm an investment manager based in our London office. I'm delighted to be joined by our regular commentator and head of fixed income, Richard Carter, as well as Will Howlett, our financials analyst. Now, good morning to you both. Last week, we saw the continuation of a theme that has already begun to dominate 2026, geopolitical tension. Following his incursion into Venezuela, Trump's attention turned east. Strong action was threatened against Iran if the authorities executed protesters. Tensions rose when America evacuated some personnel from its Middle Eastern military bases, seen as a precursor to airstrikes on Iran and precaution against retaliation. Unsatisfied with two possible military regime changes, Mr. Trump set his sights again on Greenland, suggesting military force against a NATO ally. On Saturday, President Trump posted on social media that a 10% tariff would be imposed on 8 European countries on February 1st, increasing to 25% in June, unless and until a deal is reached for the complete and total purchase of Greenland. The mood in markets this morning is one of exasperation. To clarify, a US president is threatening an extra tax on US consumers in order to force a European country to sell a territory to him it cannot legally sell. This is the latest instance of tariffs being used as a geopolitical weapon rather to address a trade imbalance. The story is unfolding and likely to change even as we comment on it. So for today, I thought we'd focus on macro and markets to start with. Indeed, it has been a busy week for both. Beginning with the former, Richard, would you be so kind as to walk us through some of the highlights in macro reporting?
Yeah, I mean, I think, James, it's obviously been, a fascinating start to the year in terms of geopolitics and everything's going on. We can come on to that, I guess, in a sec. I mean, just in terms of away from that, markets have also been focused on economic data in the States and all the rest of it. And generally, that's still okay. Last week, we had inflation numbers in the US, which were pretty much unchanged, and also retail sales figures, which are okay. So overall, we can still characterize, and markets, although geopolitics is fascinating, markets are, still got, sort of one or two eyes on what's happening on the economy side. And overall, I think that we can say the US economy is doing pretty well. Growth is pretty robust, but inflation is rather sticky. So overall, in terms of what it means for the Fed, they're probably not in a massive rush to cut rates at this stage, albeit, as we're going to come on to talk, I think about, there's pressure from Donald Trump to get rates down, so that's still a possibility. I mean, the whole macro start to the year has been absolutely crazy in a way. I mean, the kind of success of the Venezuela enterprise has clearly emboldened Trump to move on to Iran, which is still bubbling away. I know it seems to have gone quiet a little bit over the weekend, but there does seem to be a movement of military assets to that region. So that's something, a strike on the Iranian regime could still happen over the next few weeks, which obviously would be a massive deal. And now, we would think, wouldn't we, that we were dreaming this or making it up, but no, we're talking about Greenland with a population of sort of 50,000 or so. This is a worrying development. Trump's clearly got fixated about Greenland, not just, as he says, about the security risk, which I think is just a complete red herring, about the sort of, it's more about the potential for mining and mineral extraction over the next, sort of 30 or 40 years as the planet warms, and also just a kind of vanity kind of let's expand the territory of the US kind of thing. So this is extremely worrying, and how the Europeans deal with this is going to be very difficult. I mean, there's not just a threat of the tariffs, but also if they don't work, then potential kind of, you can't even believe to think it would be serious, but some sort of military enterprise by the Americans to take control. It's we'll see how it develops. Hopefully, cooler heads will prevail, but it's a worry for the economy. It's a worry for markets for sure. I think the hope is that moderate Republicans will be mobilized in Congress to put a bit of a brake on Trump before this gets out of hand. But otherwise, it could be a serious breakdown in European-US relations, and I don't think that benefits anyone.
Absolutely. And on that point about moderate Americans sort of in Congress swaying Trump's actions, I've got a stat here that only 70% of US citizens support efforts to acquire Greenland, with 47% against. So hopefully, the power of Congress is able to prevail in that instance. You mentioned that tariff spats are again a worry for global economies and markets. And that's something that the Federal Reserve is having to grapple with. But as you alluded to, Iran and Greenland are not the only ones in the US administration's crosshairs, because last week we saw that the US Justice Department issued subpoenas relating to Jerome Powell's testimony to Congress last year about the cost of renovating the central bank's buildings. And once again, the Federal Reserve's independence is being brought into question. So Mr. Powell said that the unprecedented threat of criminal charges was a pretext for attacking the Fed for not setting interest rates in, quote, the preferences of the president. Now, in reaction to that, the US dollar and yields, both sort of long and short, didn't really make a noticeable move, but, gold did. What do you take that to mean?
Yeah, that's quite a hard one to answer, actually. I think gold a little bit has its, is on, and not just gold, actually, a lot of metals prices are on an absolute tear at the start of this year. And I think there's been a lot of buying out of China in particular. I mean, certainly the more uncertain things are, and Greenland also plays into this, and Fed independence, the more demand there will be for gold. But I don't think it's just a sort of, one-off thing like the whole Powell subpoena thing that's driving it. I think there's a strong structural demand that's carrying on. US Treasuries and the dollar, you're right, didn't react hugely. I mean, in some ways for Treasuries, it's not ideal, but if it means that rates get cut a bit more aggressively, that's not, that's a kind of double-edged sword away. It's not too bad, certainly for the shorter end of the market. I think the main reason is that this is not, although it was worrying, this is not particularly new, as you alluded to. I mean, Powell has been attacked by Trump for some time now, and this ebbing away of Fed independence has been dragging on. And I think there's still a sort of, a demand for people to hold US Treasuries is still still seen as a sort of popular asset to hold. There's still good feelings around the kind of US economy and the stock market, so people want to hold the dollar. But clearly, there's a danger of what Trump is doing. And again, we go back to this sort of thing about maybe markets are just, whether complacently or not, hoping that sensible figures in the States will rein in Trump, whether that's the Supreme Court potentially on tariffs, maybe they'll be ruled to be illegal, or some of them will be, whether that's the sort of midterms that are coming up later in the year that will maybe reduce its popularity a bit. There's also kind of this Senate Banking Committee that needs to approve Fed nominees. There's a key Republican on there who said he would block a new appointment if this whole Powell thing isn't cleared up soon. So there are some voices in the US that are pushing against Trump, and I think markets are just hoping that they will lead us to a better place.
That's interesting, thank you. And again, it's the theme of will cooler heads prevail. It's interesting you mentioned the Supreme Court being a sort of reasonable counterbalance to Trump. How would you respond to the fact that he's sort of weighted the Supreme Court in his favor? There are more conservatives, to use American diction, than liberals. And that same Supreme Court has sort of continuously delayed to make a determination on the legality of tariffs. Does that worry you?
Yeah, it does worry me. I mean, it's not unusual for the US Supreme Court to be stacked, to sort of be stacked in favour of whichever party is holding sway. Actually, the view of a lot of market analysts is that the Supreme Court is going to rule the tariffs to be illegal, and that's despite people being some of the judges being stacked in Trump's favor. So maybe they're Republicans or conservatives, as you say, but maybe they're not as far in the MAGA camp as maybe he would like. So there is still a hope that the Supreme Court will, or there's still a theory that they will rule against the tariffs. But we may not know for a while, and the longer that goes on, the more he's emboldened to do exactly what he wants. And clearly, there's a lot of Republicans in Congress who maybe in their heart of hearts oppose what he's doing, but don't want to say so because it means that they might not be able to stand for re-election.
I mean, it would be quite extraordinary if those tariffs were deemed illegal, because presumably they'd have to be sort of unwound and revenues raised through tariffs, effectively a tax on imports. Would they have to be returned to corporates?
It's a massive deal. I think Trump is absolutely very scared about what that might all mean. I mean, the theory is that they would say, okay, so certain of the tariffs are illegal, so they would just Trump and the administration would just find another way of imposing the same tariffs in a different manner. But yes, in theory, it could mean that a lot of money, and they have raised a lot of revenue, a lot of money might need to be returned to corporates and all others. So it would be pretty chaotic. Although I think in the sort of longer run, if Trump wants to have tariffs on people and he's got control of Congress, he'll find a way of doing it.
That's interesting. And again, it's I think you capture it correctly and appropriately as chaotic, because again, a lot of that revenue that's been raised has already been pledged as part of his expansionary fiscal policy. See the big, beautiful bill. I think we'll leave the macro to one side for one moment, if that's okay, Richard, and thank you. But as we've been hearing, it's been a very busy time in capital markets, and not least for our financials analyst, Will Howlett. US bank earnings, as always, herald the start of the new reporting season. Will, you, much like markets in general, have had a very eventful week. Could you please pick out some of the themes that have interested you in these bank reports?
Of course, yeah. I think the results themselves were decent, but in the context of quite strong share price performance last year and quite extended valuations for some of these banks as well. So the likes of JP Morgan coming up to 3 times tangible book, for example. And then you've also had the meddling from Trump on credit cards, which I'm sure we'll come on to talk about. So you actually saw some of the banks falling on results which were a little bit ahead of expectations. So JP Morgan, Bank of America, Citi all fell back a little bit last week. In terms of themes, I mean, the US banks really do give an insight into the health of the US economy. So as Richard's been talking about, things there looking relatively benign. So call out credit losses on credit cards, certainly a topical area, but they've actually been falling recently. Trading revenues were a particular highlight, and within that, equities were strong. So really a function of animal spirits, more equity deal flow, just the rally we've seen in equity markets as well. We look at investment banking primary business, so things like IPOs and equity debt issuance. That was a bit more mixed. So JP Morgan called out a few deals that didn't complete in the fourth quarter and impacted by the government shutdown, which pushed things into this year. So not terribly concerning. And then Goldman's actually came out later in the week and then talked about having the highest backlog on its investment banking pipeline for 4 years, and particular enthusiasm about its advisory pipeline, for example, as well. I think one other area I would highlight would be the strength of lending growth. So call out JP Morgan maybe here. So average loans up 11% year on year and deposits up 6% year on year. I think it's a function of the fact that we live in a nominal world. So a little bit of sticky inflation certainly doesn't hinder the banks. And also the fact that deregulation has come in as well, and that's allowed banks to be a bit more aggressive in terms of their lending. I think the final point I'd talk about would be the cost guide that JP Morgan gave as well. So they talked about expenses growing another 9 billion this year to move to 105 billion. So another big increase for JP Morgan, but it does look punchy, but I would highlight that JP Morgan has a very long track record of investing through the cycle to capture market share and growth. And would expect this to be very much in play again this year. So yeah, I think the US banks' results themselves were fine, but just with valuations quite extended, certainly compared as well to European banks, for example, the share price reaction was a bit more mixed last week on those US banks.
Marvelous. Thank you very much for that very comprehensive summary. There was a phrase you used that's really struck with me, and it's living in a nominal world where we're putting up with a bit of sticky inflation. And well, I mean, despite denouncing the affordability crisis as a hoax in December, President Trump does seem to be on a crusade to lower the cost of living. We've already discussed his broadsides on the Federal Reserve with Richard, but last Sunday, Trump announced that from the 20th of January, firms charging an annual interest rate of more than 10% on credit card loans would be in for, I quote, very severe things. Days later, he's urged Congress to curb fees merchants pay to credit card processors, such as Visa and MasterCard. Will, could you give us a bit of a sense check? Does President Trump actually have the authority to set credit card interest rates? And moreover, if he does, what would the implication be if credit card debts was sort of capped at 10%?
Yeah, of course. Yeah. So there's two themes out there that you've mentioned. One, the tweet talking about a 10% ceiling on credit card interest rates for a year, and then also the revival of a bill trying to encourage more competition as it relates to interchange fees. Effectively, that's the cost that merchants bear when they are accepting credit cards. And so both of those, as I mentioned, weighed on US banks, but also the more focused credit card companies, and then also the payment network names as well, Visa, MasterCard, for example. As you mentioned, yeah, affordability seems to be very much the what the midterms will be campaigned on, and talking about interest rate caps is an easy way to show voters immediate relief. This is a huge market, so there's 1.2 trillion of credit card debt out there. But yes, I don't think you can't just you can't just limit credit card interest rates at 10% by tweet, sadly. So you would certainly need an act of Congress, and it doesn't seem that there's much appetite here at all. I think an executive order would be challenged very heavily in the courts, and I think the courts would prevail. I think the other avenue they have to go down is potentially around regulation, but again, there's nothing really that they can do here. I think there's more likely that there'll be some sort of negotiated middle ground with the industry, and they're trying to put some pressure on the banks to give the administration some win. I did actually see that a fintech, a company called Built, has issued a credit card with an interest rate of 10% for 1 year. So very much in the spirit of what Trump has tweeted about, but that's very kind of common in credit card industry, that you offer these kind of teaser rates and then it falls back to the prevailing rate after that initial teaser. So I don't think there's anything fundamentally changed there. So I think it's got a very low probability of actually coming to fruition. And I think if it were to happen, it would really be quite negative for the US consumer, and the US consumer is kind of 70% of GDP. So, really important in terms of driving the economy. Remember that credit cards are unsecured borrowing. Credit losses through the cycle might be typically about 5%. Funding rates might be as high as that as well, with the US Treasury, at about 4%. Bit of operational cost on top. You can see that a 10% interest rate quickly becomes loss making, and so the banks have talked about this on their earnings call and said they would meaningfully cut back lending to lower income consumers if we did see this cap somehow come into place. So that would be quite negative and hurting the people that Trump is trying to support as well with this bill. The other noise that we've had last week is on this resurrection of this credit card competition bill, effectively trying to encourage a bit more competition within the networks. So Visa and MasterCard dominating here. I think this has a little bit more chance of getting some traction, but the time frame for more for bills is getting quite short, and I think from what I've read, again, it seems relatively low possibility that this is going to come into fruition as well. So yeah, two bits of news flow last week, both weighing down on the banks and the credit card names in the US.
Thank you. Just picking up, well, firstly on the credit card side, I've got a stat here that the average American credit card interest rate is 22%. So, if credit cards were capped at 10%, that would reduce the supply of credit to around 25% of total credit card holders in America. So yeah, you're right, a huge slowdown in potential spending, which would work against Trump's stated objective of boosting growth. And of course, penalise most those on lower credit scores and affordability. It seems almost churlish in the light of all the other conversations we've been having today to say this, but does Trump have a point about merchant fees? I think it was on Thursday last week we saw a UK court ruling that regulators could potentially cap international fees for the likes of Revolut, Visa, MasterCard. Is it possible that these two mega companies, this duopoly between Visa and MasterCard, does actually constitute some sort of anti-competitive behavior?
This is a complicated question, and I think, it's a very profitable business for the likes of Visa and MasterCard. Remember, when you're using your credit card, most of the interchange actually, or most of the economics does go towards the issuing bank. First up, they are fronting the credit for the consumer, and secondly, a lot of the those fees are then recycled in terms of rewards for those credit card holders. You could argue that it's quite regressive because the people who are revolving their balances are effectively subsidizing those people that just transact on their credit cards and pay off the full each month. So it's kind of a regressive situation. But I still feel that the banks are a little bit more at risk at this relative to the payment network names. So Visa and MasterCard obviously fell off last week on the back of these comments coming out of Trump and a Republican senator, I think, pushing the credit card competition bill. But remember that Visa and MasterCard take a very small share of the economics in these transactions. In the US, they have tried to push down interchange rates successfully through the Durbin Amendment, I believe it was, and you actually saw, limited competition in terms of those network fees for Visa and MasterCard, but you did see pressure on the interchange rate, which the US banks effectively collect. So remember, I feel the industry dynamics are quite favourable for Visa and MasterCard. Obviously, they've got this huge duopoly. I suppose, the concern is if regulation it becomes too aggressive to really try and break that up. But for the moment, I think that the pricing dynamics are still very much in favour of those two.
Amazing. Thank you very much. Looking to the week ahead, we'll be keeping an eye on UK employment data on Tuesday, followed by inflation data on Wednesday. Both will help inform the Bank of England's interest rate decision in early February. On the corporate side, Netflix and Intel will this week be publishing their latest figures, which we'll be sure to update investors on. And that seems like a good place to leave it. So a big thank you to Richard and Will for those great insights, as well as to you all for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please do review the show and share it on your socials, tagging us at Quilter Cheviot. So as to not miss a future episode, please tap the subscribe button. We will be back next week, but in the meantime, please head over to our website on www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date on our thoughts on market news, industry insights, and our upcoming events and webinars on our website or via our social media pages. Finally, do you have any questions you'd like to ask one of our experts for the next podcast? Simply submit them via the weekly comments page on our website. We would love to hear from you. And that's it for today. As always, a big thank you to Richard and Will for your time, and to you all for listening. Until next time, goodbye.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.